Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today we're going to do an update. This is our last update for September for the Las Vegas real estate market. And what we're also going to do, we have some very interesting numbers that we're going to share with you that will probably explain why home prices have not absolutely tanked and why they've actually still been going up and what is causing that. We have some very interesting numbers that will put things in perspective for you.
Right.
Okay.
Cool charts, so come along with us and enjoy the ride.
Okay, so here we go. Here's the first one. This is the thing we always do, market action index. It's been 46. It was actually 45 last week. It's 46. So the market has gotten hotter week over week. Juana, why is that unusual?
Because this is the end of September, and it's supposed to be cooling off, right? It's supposed to be like the best time to buy a house when there are more houses on the market, sellers are more motivated, is usually October, November, December, January, and this is going against the grain.
What if I were to tell you that there's less houses on the market today, the end of September, than there were in March?
I would believe you because inventory has...
You're not supposed to say that.
Well, I would, okay, because here's the thing. Inventory has behaved so much differently than it has traditionally that right now anything that goes against the grain I think is more likely than what we would expect.
Okay. We're going to flip over to the real-time market profile. Median list price is moving sideways, maybe down a little. The median price of new listings is moving sideways, nothing exciting there. Price per square foot, $260. It was $260 last week. In June, it was $256. It's not substantial that it's changed $4 per square foot since June. What's unusual, usually dropping from June to September because there's more houses on the market. There's some softness in the market. Home prices tend to go up in the spring. They drop a little in the fall. They go up in the spring. They drop a little in the fall. We're at the point where they're supposed to be dropping. They're not. Juana, how unusual is that?
It's really unusual. But I mean, look, the market has been anything but normal like all of our lives for the last 3 years. And I've said this before, the market is just kind of reflecting what's going on in people's heads from the perspective that the pandemic and the response to the pandemic kind of jumbled things up in people's brains, and it also jumbled up our behavior out in the real world, and this is illustrating that.
When you see median rent and you see it's $2,200 and it looks like, oh, it fell, but the numbers are extremely small numbers. They're dollars. So it looks, on median rent, it's not very significant. Even on price per square foot, that's only $4 a square foot, but you can see the movement on there. Okay, here's price per square foot. You can see price per square foot's about what it was this time last year. More than 2021, though. 2021 was a pretty hot year. And then you can see that it going back to 2018, it was down to about $1.75. It's at $2.60. If I were to have you guess, Juana, we're going to do math in public. If you don't get it right, okay? If you don't get it right, real estate in Vegas today is going for $260 a square foot.
Okay.
It was going for $175 a square foot 5 years ago.
Wow.
Okay? If you had to guess, what is the annualized annual return per year for those 5 years? Is a percentage?
Oh, you mean like compounded?
Yeah, just the percentage, annual percentage.
Okay, quick dirty math, 13%.
It's 13%.
Okay.
Okay, it's 13%. Now, you're probably saying, wait, but home prices normally don't go up that much. Yeah, most of that, as you can see, all happened in 2 years. It happened from 2020 to 2022. We've been moving sideways, moderating like we said it was going to happen. Okay, but let's compare a couple other stats because people are all excited. 13% over 5 years. Nobody can afford to pay 13% more than they did 5 years ago. Wanda, what do you think gas is compared to 5 years ago?
I have not bought gas in a really long time.
Why have you not bought gas in the last 6 years?
because I fuel my vehicle at home in the garage.
Your Tesla, have you taken your Tesla to the gas station just to clean the windows?
You just told them I drive a Tesla now. Before they would have thought that I just had an underground tank and just fueled up at home. Now you've blown it.
Underground tank. Okay. Here's another one. Real wages in the U.S.
Mm-hmm.
This is going to surprise you. In 2018, 61,000 was the median wage. Median, not average, median. The median's higher. Today it's 78,000. I went into a ROI calculator.
Mm-hmm.
Guess what annual percentage in household wages that is per year?
11.
It's 11%. So real estate is in Nevada, Las Vegas, has appreciated 13% per year. Yes, there was a spike in 2022. Wages have appreciated 11%. What do you think the S&P has gotten in returns the last 5 years?
15%.
11%.
11%. So the S&P has done the same thing as wages.
Yep.
And housing has done 2% better than wages.
Yeah. And people are freaking out. Now, here's the problem, Juana.
So wait a minute. So the difference between the S&P and housing is 2 points. And somehow this is dramatic?
Okay, here's the thing. This is what's funny. Okay, you ready for this? If you had bought in the S&P, you would be up 11% per year, right? If you had bought an investment house in Vegas, not only would you still be up the 11% per year, you would have probably collected 7 or 8% more in rents.
Mm-hmm.
So effectively, you would have gotten a 17 or 18% ROI, crushing the S&P 500, buying something that's probably far more risk-free than the S&P, investing in the S&P 500.
Right.
Okay.
Well, so so I'm just going to say something real quick. The reason Todd's saying that real estate is safer than investing it in the S&P 500 by and large is because housing, barring some natural disaster without insurance, is still going to remain. So while a stock, you take a stock, a company that can lose its value either due to some sort of mismanagement or due to a bankruptcy or something like that. So you can end up with that stock being either extremely devalued or even zero versus a house, which providing there's not some natural disaster without insurance, that house will still be standing even if maybe it doesn't appreciate that much.
We are not saying you should run out right now, buy a house. It's a good time to buy. I don't know. I think people just put crap in the comments without even watching videos. We've never said it. We're just pointing out why. Okay. Now here's another interesting thing. We'll go to the next chart after this. If you had to guess one, now remember that we're talking only about the top half. So in Vegas, that's like 1.3 million people, and it's probably 800,000 households. Okay, that make over that 78,000 a year.
Right.
There's only going to be about 40,000 houses transacted. So 1 in 20 of the top 400 or 800,000 households will run out and buy a house. Okay? We're not talking. So the problem is we get a lot of people who don't make that kind of money. And they're complaining, oh, well, with these interest rates, I can't buy. What do you have to say about that? Because we've sold houses recently to people who make $200,000 a year and they're first-time home buyers. And they're like, yeah, we make $200,000 a year. We want to spend $800,000 to buy a really nice house.
Okay. So I'm going to say 2 things. One, the people say that with these interest rates, I can't buy a house. 2 things. One, you probably can, but probably not the house that you would have wanted. So if before you were looking at a house that was $700,000, maybe you're looking at a house that's, $550,000 now. Okay. You can buy a house, just not the one that you wanted. And those people will say, hey, I can't buy any house at all. Then my position is you probably couldn't have bought a house at all anyway, because you lack the you lack the savings, you lack the reserves in order to safely buy a house. Because remember, buying a house is more than just about the payment, right? It is about the down payment. It is about having at least 6 months of reserves. That if you have some sort of catastrophe happen, if you lose your job, get hurt, whatever, you still have money to make your payments and live while you're recuperating. So there's more to it than that. So I'm sorry for those who can't buy. The number of those people versus everybody else is actually relatively small, and those people are less likely to be able to buy in any environment so long as lending practices are good and stringent, and they only approve qualified buyers who have good credit, who have shown a level of financial responsibility, of financial knowledge, how to manage their money, so that they can be good borrowers who are going to pay their debts back.
Okay, next chart is inventory. Now, as you can see by this chart, the dots are the same day for the last 5 years. Inventory has peaked and starting to decline. Mm-hmm. Juana, if I were to show you this chart and take away the dots, mm-hmm. and just showed you the end and mm-hmm. said, based on this inventory declining and then starting to pick up, what month would you say we're in? But remember, you don't see any of the chart except for the last maybe eighth of it.
Right. So I would say that we're in the spring, that we're in April, and that we're getting ready to head into summer.
Okay, but we're not. May, June, July, August, September. We're at the very end of September. Mm-hmm. We're almost 6 months out of sync, right?
We are.
If you look at this chart, every October inventory is peaking and dropping.
Right.
Where the hell do we go from here? If inventory is supposed to drop, peak and drop, how do we get through the winter and the spring if people don't start selling their houses? Like, what is going to happen?
So I think it's going to be a very difficult winter for buyers, because I think it's going to be even less inventory. So that's the first part. Now, springtime, I see something different. Springtime, I think people are going to just get on with it.
Okay.
I think they're going to get past the holidays, and those New Year's resolutions will kick in, and people will say, you know what, it doesn't matter anymore what the market's doing. My family needs this, and we're going to go ahead and put the house on the market, find a house to move into, and it'll all be fine. I just think that people have limited capacity to stay hunkered down. I think we're, as a species, we're meant to move forward. We're not meant to be stagnant.
I think people are making decisions to live their lives. Mm-hmm. Yes, you remember, the bank won't loan to you unless your loan to value is 37% or less, mm-hmm. for the most part, okay? So it's not like this, we have to pay
So 37% is your debt to income ratio.
Right.
Not loan to value.
So if you make $5,000 a month, they're not going to lend you money on a house where your mortgage payment be $3,000. Mm-hmm. Right? It's going to, if they'll say, hey, it's below 2,000, that's like the most we can loan to you. Mm-hmm. So this idea that people are spending like 80% of their income on their mortgage physically isn't possible, right? You Correct. Either have to put more money down or do some other thing.
Right. So remember, lending standards, right? I talk a lot about this. The lending standards are much better now. They require people to have better credit, people to have to put higher down payments, to have more reserves. So all of that goes toward having better qualified purchasers, which allows for a greater chance that the loan will be repaid.
If you had told me we would have 7% interest rates, mm-hmm. which we do, that home prices would be $260 a square foot, mm-hmm. and but in Las Vegas we had 2,200 houses on the market, mm-hmm. I would be saying, wait a minute, how is this possible, right? Mm-hmm. Why do we have so few? We should have 8,000 just in Vegas. The whole MLS would probably have 15. It would be the most we've had in probably 16, 17 years, right? I think the thing that surprises me most is this low number of available homes to purchase. Yes, 100% agree. If we had a normal market right now, if we were up at the peak, even if we had 2022 type inventory last year, which was over 5,000, so we're more than twice as many. Remember, the bottom of this chart's 1,000, so it's not zero. I would say, hey, you would probably get a smoking deal on a house October, November, December, January. Mm-hmm. I would say give it a couple months and take a look. Now, honestly, I have no idea. I do know this. Rental homes, a rental home that you could have bought for $320,000 cash 2 years ago at this exact time is $400 now for the exact same house.
Yep.
And the rent isn't going to be substantially more.
No, not at all. So this is an interesting thing. So the rate of return on rents is actually diminished. So for those of you who are anti-landlords, there you go. It's actually diminished. But that doesn't mean that it's still that it's not a good investment. It's still a good investment. It's just not the same as it was. And look, anybody who thinks that everything's going to be the way it was yesterday, I have a newsflash for you. I'm never going to be as young as I am today. I'm never going to be as healthy as I am today. And that goes for most of us, right? Yesterday is gone. So we need to deal with today, and this is where we are. So we need to make decisions based on what's happening in the market today and not keep looking in the rearview mirror because there's nothing there for us. That's in the past.
This goes kind of on what we were talking about before. The top 25% of households in Las Vegas, okay? So 400,000 households, right? Mm-hmm. How much money do you think they make, the top quarter? The bottom of the top quarter.
The bottom of the top quarter.
So if you ranked all households top to bottom and start at the top, and there's probably a billionaire or millionaires or people that make hundreds of millions, right?
Right.
And then you would get down quickly into the people who make hundreds of thousands.
Okay.
And then at what point, when you get to 25%, what do you think that amount is? I happen to know the amount.
It's probably around 80,000.
It's 120.
Wow.
Because the median's 78.
Mm-hmm. Okay.
So the median's 78. So the 78 to 120, you have a quarter of households that make that. Okay. So call it 80 to 120, right? But a quarter make over 120. And some of those people make 3, 4, 5, 6, 700,000, right? We know a lot of those people. Mm-hmm. Okay. They own businesses. They're airline pilots. They have super high, real estate agents that make a ton of money or whatever.
They're professionals.
They're professionals. They're doctors, dentists.
Right.
Okay.
They tend to have small businesses, yes.
We have seen these people, even this year, walk out and say, hey, we're buying that $2 million house.
Oh, yeah.
And not even blinking.
Right.
I do not believe that with this low inventory, even with the current interest rates, this is going to cause much downward pressure on prices. If you don't believe me, why has the price per square foot, the average sale price of homes, climbed in the last 6 months? It doesn't make any sense. It shouldn't do that. With interest rates double what they were 2 years ago, we have home prices going up. It's all because of inventory. Mm-hmm. And it's because what we've done is we stripped out all the people on the bottom, the lower income earners, people with less down payment, right? And who do we have left? We have two types of buyers. One, cash, high income, or high income people putting down large amounts of cash.
Right. So you have cash buyers and well-qualified buyers.
Right, okay. Exactly.
So what does that mean? It means stability. I mean, honestly, what that means is stability. It means that the housing market will be stable going forward because these are people who have equity and they're not going to be sensitive to any sort of external factors that would otherwise force them to fire sale their home. There's no scenario under which that would happen because they have equity.
This time next year, a year from now, forget prices, okay? Do you see more home sales happening or less or the same?
I think I see more. I do. And it's not because interest rates are going to be any different. They're not going to be substantially different. I just think that, like I said, people are adaptable. We're not meant to stagnate. And this thing where people have been in a holding pattern for a year, it's not going to last. People just, at some point, just say, I'm going to get on with life.
Yeah, I agree. I think that home prices, who knows? My personal opinion is they're sideways. They're not substantially different than they are today. So for me, if I had $400,000 cash and I was going to buy a rental and I was going to time it, I wouldn't wait for a better opportunity, and this is why. Because every month I wait for price to go down, I'm losing a month of rent. I'm losing a month of rent. So if I'm getting $2,000 a month in rent, I'm getting 0.5% a month in that money. So I'm losing basically 6% a year by waiting a year to buy the same house I would probably buy. If I thought the home price would be substantially less in a year, I might wait a year. So just like, I'm just thinking about this because obviously we're talking about buying rental houses.
They would have to be a lot less because that rent that you're not collecting, there's no way to recover that.
Right, yeah.
So that's a consideration as well. So let's say that you were looking at a $400,000 house, and let's say you get that $400,000 house for $380 a year from now. Well, that's nice, but you got it for $20,000 less next year. But in the meantime, you lost maybe $25,000 in rent. Well, how's that helping you? Because you actually are $5,000 to the negative. That's not helpful.
Okay.
And then, you've got the certainty of buying now and knowing what the price is versus the uncertainty of sometime in the future.
And we're not saying you should buy now. We're just running these scenarios because I don't believe I think prices are going to moderate again for a year. We said this 18 months ago. We got ridiculed for saying home prices would moderate, and I think they're going to keep moderating. I don't see much upward home price pressure because I think interest rates need to come down for that. I don't see much downward because we don't have enough people willing to sell. And I think we're just stuck in this. We're going to be stuck in this kind of funk. But I do think it gets better because I think next year we do have lower interest rates than now. And I think we do have more transactions. Homes come on the market, so there'll be more homes sold.
Right. And I think the winners are the people who buy homes sooner rather than later because they have the opportunity to, I guess they have the advantage of time is what I'm thinking, is they have the advantage of time where they're not necessarily in a rush and they can just take their time and find a home. And then by the time they find the right home, that's a good time for them. They buy the home and, within maybe 24 months, they refinance the home and now they've got the home that they wanted in the first place and they've got a better interest rate. So I think those people are going to be the winners.
Oh, last thing. A brief update to the Las Vegas economic condition.
I like those.
Las Vegas has added 8,500 jobs in the last 2 months. Las Vegas is number one in the nation in job growth over the last 3 years. Of course, as some of you know, we had 30% unemployment in 2020 at one point because the strip was closed, right? Everyone was sent home and then they were closed. The hotels and everything were closed for a few months, but even when they opened, they didn't open fully. A lot of them only opened partially, right?
Right.
We've gained all those back. We're down to, I think, 4.7 or 8%, which is higher than the national average, but it's still pretty low. I will point one thing out. We have 3 hotels opening. We have 3 big venues opening up with permanent full-time jobs, right? We also have natural growth that happens just because we have more people coming here, right? All of that requires housing stock to house the people. Currently, it appears that home builders are building maybe to meet the demand. But maybe we don't have oversupply. I don't think we're going to have an oversupply.
Yeah,
and I'm not counting apartments because they don't count.
Right. But we are building a lot of apartments. And they're really nice. They're in nice neighborhoods. So that's a good thing, right? That's a good thing. People need to live somewhere. So Vegas is still a really nice place to live. One of the reasons why Vegas is such a nice place to live is because so much of it is new, right? Vegas is growing all the time, so that creates growth. So we have lots of new housing stocks, lots of new apartments. We have big, beautiful, wide streets. So those are all nice things which make Vegas an attractive place to live.
And jobs are growing in Vegas and wages are growing.
Right.
And all jobs in Vegas are not temporary jobs. I know people who have worked at the same hotel, casino, et cetera, for over 20 years.
Right. Yeah. So, look, just like with anywhere else, there are jobs that are stable and there are jobs that are more transient. But for the most part, Vegas does have a pretty stable job market. We're like anywhere else, right? Businesses come and go, but for the most part, most of us are employed long-term with our employers.
Yep.
Okay, so that was a long video. Sorry about that. Leave us some comments. Tell us what you think of the charts. Tell us what you think about your market, the Vegas market, anything that interests you. We'd love to hear it. Please remember to like the video, subscribe, hit the notification bell, share the video, and we will see you on the next video. Bye.
Bye.